this computer. Okay, so good morning, everybody. Welcome to our training today. Today, we're going to be looking at risk management, the make or break of a forex trader. And obviously, we're looking at this from Anzo Capitals and powered by Anzo Capital. Okay, so let's jump right into it. First off, we want to look at the risk disclaimer. You need to understand that when it comes to trading the forex or currency market actually does involve risk. You want to ensure you're trading with risk capital only. Whether you're trading stock, forex, futures, options, cryptos, you know the drill. You want to trade with money, risk capital only. I'm going to be your host as usual. My name is Nana Alexander. I'm senior market analyst at Anzo Capital, a professional forex trader, fund manager, and a forex coach, and aka the forex chief or the FX chief. So today, what we're going to be looking at, not watch lists, more like content. We'll look at, so today's class is not going to be the most exciting. If you're looking for me to look at chart and show you strategies and show you whatnot and all of those things. But today's class is the boring part, but actually the most important part, right? So now we want to understand what it is we're doing, right? Now, when you listen to several forex trainings online or in person, they usually just talk about all the potential for profit, or the potential for making money, how you could, if you go on Instagram, you see all of those fake ass forex gurus driving a Lamborghini or a Porsche and all of those things, showing you how, they are making all of those hundreds of thousands of dollars, in a day or two or something like that, without actually talking about the downside. For the reason, today's class, we're going to look at the reality and how this is not a disadvantage, actually. It is something that you can do to give yourself an edge in the market. So let's jump right into the first point. Let's look at defining risk. So the first subheading here says, define risk, accept risk, eliminate risk. True. We all know that when it comes to forex trading, it does involve risk. As a matter of fact, all our trainings begins with the risk disclaimer. But is it just forex that involves risk? No. Every single thing in life has risk. If you go out, you're at risk. If you stay indoor, you're at risk. If you walk about, if you exert yourself too much, well, you're at risk. If you don't do anything, you're also at risk. So just because there's risks doesn't mean it's a bad thing. What it just means is you have to more or less define the risk and then make sure that you have to push yourself, risk something. You've heard that statement. You can't risk. If you don't risk it, you won't get the biscuit. Right? To get the biscuit, you have to risk it. There's risk in driving. However, it is very risky to drive blindfolded. So even if while you're driving, you can observe all the signs and do all the things properly, but a drunk driver can smash onto you, or something can fall out of somewhere that doesn't really have anything to do with you. So even though you play your part, there is some risk. You can do your best part to inculcate in your children good habits and all, but there's no guarantee that they would, actually follow through with it. But you still take the chance in doing that. To be successful at anything, you need to have a good plan. Now, if I tell you, okay, so friends, let us start a business. And like, okay, what business? I don't know, any business. Okay. Let us start selling airplanes or something. And we're like, okay, how much is an airplane? Well, let's go and buy one and let's look for where to sell it. You already know that business will fail, right? If I ask you why, what would be the reason? So quickly, why would that business fail? The business we just decided to do like that. Why would it fail? Quickly, your response, or just type it in. I want to make the class as interactive as possible. Okay. So why would the business fail? The business that we just decided, well, I think we need to do a business. Let's just start up and let's start selling Xerox printers, or let's start selling cars. So we'll just go, okay, no business plan, nothing. Why would it fail? I've already mentioned it. Anyway, I can't wait for all your response. But the reason is there's no plan, right? before you jump into anything, whether it's a business, even in the Bible, it says, before you build a house, you have to calculate the costs and see whether it can actually be done. You don't just start building the house and then you start winging it, saying, okay, we'll just wing it on the way. You'll not succeed. So to be successful at anything, you need a good plan. Now, trading is no exception. But the problem is this: in order to become a computer scientist or a doctor or a surgeon, or a dentist or a dental therapist, whatever, you need to go to school. You need to pass certain exams. You need to pass certain practicals. There are a lot of things. You spend 4 years or thereabouts learning and trying to get better at it. And before you are given a certificate that you are now officially a computer scientist or a biochemist or whatever. How about forex trading? Well, there's no barrier to entry. So you have capital, there are brokers everywhere. Anzo Capital is one of the best. And just with your capital and obviously a valid ID, you can open an account and you're already a forex trader. You can go on your Facebook or your LinkedIn and just put professional forex trader. There's nothing stopping you from doing that. There are no barriers to entry. There's no guidelines. In most cases, say, okay, you go through this process, you have to learn how to do this profitably. You just jump in, you learn a few strategy and you start. So there is no actual planning to trading. It's only dreams in most cases. I saw somebody made $10,000 or $20,000. Well, I want to do the same thing and I want to buy this car or that house and this stuff and that stuff. And they jump in with no plan, or it's big expectation. And what do you expect to happen? Well, they fail. The videos I play in the beginning, you could see that, if you just show up, right, you'll be shown up. If you want to succeed, you have to do the work, right? And then having a good plan is actually the first step to doing the work. To be a great forex trader, you need to understand risk, because success in forex trading is largely dependent on your ability to be able to take unemotional, decisive action over and over again. And to do this, you need to define and accept your risk even before you place a trade. Hence, you should know what you stand to lose if you're wrong before you even pull the trigger. So defining risk is very key. So for example, if you're looking to take a trade, right? So you want to take a trade and you feel based on your analysis, right? So based on your analysis, you're like, I'm going to go long. So I'm going to buy from this price down here and I'm going to try and take profit at this price, right? And then you're like, okay, I'm going to use one standard lot, right? You're going to use one standard lot where each pip is $10. And this is, you're trying to make, let's just say this is 100 pips. Right? Now, usually, how do you think about a trade? In most cases, most traders, once they look at a setup or they see something, they think about how much money to be made, right? And then they pull the trigger. They are trying to say, if I get this thing right, well, I'm going to make $1,000. And then, that will be good. I'm going to use it to do this. I'm going to use it to do that. However, they fail to pay attention to potential downside. So like many times you find they don't even use stop loss. And when they use, let's say they put the stop loss here, they don't even really calculate how much they stand to lose. Now, if the distance between your stop loss in this case is like 50 pips, well, you're risking $500, which is not, risk to reward ratio is not necessarily bad. But what if your account is $1,000 and you open a trade where you're risking $500 if you're wrong? Now that is risky. So even though there's risk in trading, you want to understand that you can eliminate, reduce. Actually, it is your job to try and define, accept, and eliminate risk as quickly as possible. Now, let's push further to the next slide. We'll come back to this in a bit. You want to avoid unnecessary pressure, right? Now, in order to be successful in trading, you need to treat this as a business. You need to treat it as a business. Think of yourself as an entrepreneur and you're trying to build a business. Now, in order to succeed in that business, you need to have a plan, and you need to have a plan, and you need to try and have a strategy for achieving your goals. Now, forex trading, most of the time, people they hear about forex trading or see people trade forex, and they only think about how they made so and so amount of money, or how this person is doing so well. Somebody look at me and like, I'm so good at your forex trader, just forex trading you're doing. Man, I need to learn this forex trading, so that I can do this or do that because you're doing it. Well, I did not start doing this or doing that today. I've come from a long way where I've paid the price, I've mastered system, I've gotten better. But usually when people jump into forex, well, they only think about all the profits they want to make, which is actually why we offer copy trading or asset management, such that while you are learning to trade, right, you can then be leveraging the skill set of professional traders. And then because you're in control of your account, as you're seeing things go, whether if you like it, you continue. If you don't like it, you can disconnect. You can manage your risk. But the point is, at least if the trader is a professional or has a system, then you're likely to do well if they are doing well. But that's not the point we're talking about today. What we're talking about today is you yourself as a trader, managing your trades, understanding risk management, and becoming an all-round better trader. The profit potential in the forex market is huge. We all know that. But successful trading can be tough. If you've not heard that before, you should hear it now from me. It's not all joy rides, especially when you're just starting out. So you don't want to make it harder for yourself by putting extra pressure on yourself and your account. So what I mean is this: somebody is like has learned about forex. Probably you've learned it, too, and then you've come to my class and you've made some money in the past from things or ideas or even signals that I gave, and you're like, I'm going to face forex full time. I'm going to stop everything I'm doing and face forex. Well, why that can work? It's going to probably be the hardest route to go. The reason being, it will put unnecessary pressure on you. So take, for example, if you have an account. So let's say you have a job. So you have a job and you're being paid, let's say $400 or $1,000 a month. So let's just keep it conservative. So you have a job and you're earning 100,000 naira a month. That's just been small, right? So you're earning 100,000 naira or whatever, or how much you are earning a month. And then you decide, I'm going to trade forex. I don't like my account. My account is stressing me. The work is so hard. I'm going to fund my account with this $3,000, and then I'm going to be trading. Maybe because in the past you funded you had an account, and maybe you've grown the account small, and you're thinking, I can easily be doing $200 or $500 every month, and that will be good. Well, the problem with that is it will put unnecessary pressure on your forex account, because the truth is, when it comes to forex trading, I don't control the market, neither do you. Nobody does. So we might have a good setup. Take our Euro card setup, for example. The market setup might look really good, and we might anticipate a certain move. However, the market would have a different idea. Even though eventually the market will still go the direction we probably think it will, but the market might take longer to get there. Now, if you quit your job and face forex, that means, if you quit your job and face forex, then you will still need to feed. You need to eat, you need to pay bills, you need to pay rent, you need to, buy clothes and all of those stuff, which your salary normally would cover because your salary is a fixed income. However, forex is not a fixed income. So when you hear somebody say, I'm averaging around 15% or 20% or 10% per month, doesn't mean they make 10% every month. I'm going to give you an example, right? This year, okay, let me break it down this way. So this year, on my account, I'm up good amount, right? Now, in the past 4 months, right? In the past 4 months alone, there were 2 months where the profit wasn't good. And then there were 2 months where the profit was really good. So we're saying a month where it was like 2%, less than 2%, and then another one where it was a negative 1.3%. And then I had months where it was 17%, and 35%. Now, when you do the average, it will come out at something like 17, 18% on the average per month. However, it wasn't an 18% average per month. Now, if my only income was from forex trading, that means those months where I had drawdowns or very little profits, what would I do? I would not be able to manage because it will put unnecessary pressure on me. Now, sure, I have money in the bank and all of those things. My case is different from yours, but you get the drill, right? So maybe I would have been, definitely I would have been able to manage. But if you put your entire, especially if you're a family person and all of those things, if you put so much pressure on your account, then, you would need to make profit. You would then be seeing, you heard that statement, if you're looking for something, you see it. So if you're suspecting somebody to be bad, or you're expecting your girlfriend or your boyfriend to that they are cheating on you, you start seeing signs that they're actually cheating on you, even though it might not be there. So if you need to make profit because of the pressure on your account, it will cost you to take unnecessary trades and make unnecessary risk. And the goal in trading, one of my key mentors once said, if you watch the bottom line, Charlie Munger, Warren Buffett's key associate, he once said that if you watch the bottom line long enough, if you manage the bottom line long enough, you'll be able to see the upside, right? I'm not putting it exactly, but something like that. So if you manage your risk properly and stay constructive, then you would be able to weather the storm when they come and make profits at the other end. Successful trading is not about all profits, it's about managing bad times. Traders have bad times. So you have life, in life, that as well. Sometimes things are rosy, sometimes things are not. But the difference between a successful trader and an unsuccessful trader is when things are rosy, he's doing very fine. And when things are not rosy or things are not nice, he's only doing, he's not doing too badly, right? But the problem is most people, when things are rosy, they are doing fine. But when things are bad, they've blown their accounts, right? And so they come into this vicious cycle where they fund an account, they grow it a little bit, they see, I can make a lot of money, and then they blow it back. So those bad times is enough to wipe them out. And the good times is not even big enough. It just fills their head with possibility. So one way to avoid that is to avoid unnecessary pressure. You don't need to trade every day. You don't need to trade every single signal. You don't need to trade every single pattern. Wait for the market to come to you and then trade the market. And so, but if you're impatient because you need to pay bills, you might think, let's say you saw it in the past, it did like this and you were waiting for it to come down and it didn't come down and it continued to go up. And now you're like, I'm going to take this thing now because it happened before. And you buy it this time. Instead of it to go up, it continues to go down and you find yourself sitting on a big drawdown. And when you look back at the trade, you're like, I shouldn't have taken this trade. There was no confirmation or something like that. So you want to avoid unnecessary pressure to the forex trading account. Next, you want to give yourself an edge. Now, giving yourself an edge involves a lot of things, actually. It does involve a lot of things. But when you put it together, you need to understand something. You have no control over the markets. I do not have any control over the markets. Nobody does. So don't try to control the markets. What should you do? Flow with it. Now, giving yourself an edge is defining your own principle. I keep talking about how every single trader is different, right? So even if I pour everything I know into your head, I expect you to be your own trader, not me. My own style is different in terms of my temperament, my risk threshold, my capital base. There are a lot of difference between you and I. You might have more money than I do. And if I try to trade like you, I'll probably get burnt, right? So, and then even if we have this amount of money, I might have a different level of risk threshold where I'm very uncomfortable below a certain level, and then you are very uncomfortable below a certain level. So you need to understand your own trading based on your own self, not in comparison to others, but trying to be the best you there is. Now, one of the first key points to giving yourself an edge in the market is you need to start trusting your education, not yourself. So what do I mean? Usually that, in life, you hear people say, trust your heart, follow your heart and all of those things. Please don't follow your heart in the forex market. Follow your heart anywhere you like. Follow your heart in choosing your wife or your husband or whatever. Follow your heart in doing that. But when it comes to forex markets, please don't follow your heart, right? Because your heart there, it's your emotion. That is just your own emotion. You see something going up, 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 and the first thing that comes to your head is buy, buy, buy. This thing is going to go up. It happens everywhere. It happens in every market cycle. Bitcoin is down. Nobody is looking to buy it. And then when it starts going up and it's shooting, everybody's like, this thing is going to get 100K tomorrow. If I don't buy it today, it will. And then they buy and the market turns over. And then they are looking at it and it's going down and it's going down. And they're like, what exactly is going on here? This thing is going to go to zero. And then they sell it, take a loss, and then the market start going up. It's your heart. It's not necessarily a bad thing. It's just we are built as humans. Our natural tendency works against us in the markets. We are greedy and we are fearful, and we are those things at the wrong time. Warren Buffett once said, be greedy when everybody is fearful, and be fearful when everybody is greedy. So don't trust your heart, trust the chart, trust your education, but don't trust your heart. Now, don't dwell too much on past experiences. So what has happened in the past? Now, a saying you should have in front of you every single time is win, lose, or draw. Anyway, there's no draw, but whichever, win or lose, it doesn't matter. The only thing that matters is, did I follow my rules? So win or lose, not a problem. The only point of interest is, did I follow my rules? Now, so what do I mean? If you have a system, if you're deciding, you can just be focused on trading just one strategy. So let's say you're trading the moving average cross strategy or anything, for example, or divergence or anything. And you're trading the moving average cross trading strategy. So when the 20 moving average cross over the 50 moving average or something like that, you look to buy and you maybe you place your stop loss at a certain level and your target is twice your stop loss or stuff like that. And so anytime the setup materializes, you will pull the trigger. So anytime you see the setup, you pull the trigger. Well, if that is the rules, last week in my Wednesday session in the office here, the physical class training at the office, I did talk about I did talk about something like this, the difference between looking at watching a video on YouTube or attending the training and looking at a system, a strategy work perfectly as opposed to actually trading it, right? So, but the goal should be what you need to define your rules for trading. So your rules for trading should include 3 key points. Where is the market going? What determines my entry? How do I enter? So in this case, it will be the crossover strategy. This is an example though. And then if I enter, where do I exit for loss? And then where do I exit for profit? And once you have those things defined, whenever the market condition meets your specified requirements, then you know what you do? You pull the trigger. So you pull the trigger 100% of the time, you find that setup and keep your stop loss and your take profits based on your rules and trade that at least 100 times. I'll say 1,000 times, but just even to be conservative, trade that at least 100 times. Now, what's the reason for that? Why not 10 times? Why not 5 times? But the reason is simple. The market, there's 5 times or 10 times is not enough sample size to know whether a strategy is actually good or not. Yeah, not all strategies are good, but you cannot really tell which one is good or which one is bad if you don't test it well enough. And then testing it well enough means you have to stick by it. It is not, okay, so you buy the market here and the thing is going down, it's going down, it's going down. You're like, this thing is going to go close me, it's going to close, and then you close it. Maybe before it closes, get to your target. Now, why that might save you some money sometimes, At other times, it will also cost you some trade. It also means that let's say you buy a market and then you put your take profit at this point, and the price is going up. And then as price is approaching, it makes you feel like this thing is going to go up further. I'll move my take profit up. And then, you find something like this. Now, even if it goes up to hit your target, it will then form bad habits in your mind to cause you to keep adjusting things left, right, center. Now, as you get better, you will find a way to, you probably come up with ways to optimize your trade. When you've become more experienced, but before you start looking to optimize your trade, you need to trade the system long enough to be sure, to verify to yourself that it works. So win, lose, or draw, the only important question should be, did I follow my rules? So don't dwell too much on past mistakes. So you took trade and then you went on to hit loss. Go back and look. If a trade hits your stop loss, go back and look at the trade and see if you actually traded the system properly. Did you enter too early? Was your criteria met? Did you wait for your own certain types of confirmation? If yes is the answer, then it's okay, no problem. You move on to the next trade. You already know that you're not going to win all your trades. But if you stick to your rules, you'll probably come out on the other side better. Okay, I hope we're on the same page. I hope we're following. I hope we're enjoying the class so far as it goes. Now let's proceed to the next slide, which is actually stopping destructive trading behaviors. Now, as humans, we are creatures of habits, and this means that we tend to do that which is often repeated. Now, that's a statement from Napoleon Hill. We tend to do that which is often repeated. Now, when it comes to trading, your natural human emotion works against you. And this is why people tend to make a lot of profit on demo accounts, but then when they jump over to live accounts, they struggle. Everybody here, I'm sure we've all traded on demo, and it was fun because we're making profits. You were seeing profit and you were making profit. But when you started trading live, was it as fun? Was it the same? Were you making the same amount of profits? And why was that? I'm sure the answer to that is no. You were not making the same amount of profits. It wasn't as fun. Well, the difference is in the fact that there's no emotion when you're trading on a demo account. If you're trading a demo account, if you lose $100,000 on the demo account, does it affect your life? The answer is no, it doesn't. So if you have an open trade and you use 10 standard lot or 1 standard lot, and then will you even remember that you took a trade the next day? Maybe you just open your chart and you see, okay, that trade is in minus 3,000, and you will not leave it to turn back. Or you open the chart and you see that this trade is in plus 4,000, and you close it and you're like, I've made 4,000 today. And if I was doing this in life, man, I would have made plenty money. The problem is when you trade live, your emotion comes into play. Now, the emotion is always there when the trade is going in your favor. So for example, you take a trade and then you follow your rule, and the market, you already know the market does not go straight up. So you bought here and price is going like this, and then you see the market do like this, and you're like, it has probably not negated your outlook, but because the market is going in your favor, you're looking at it, and maybe your target is up here. This trade structure is still in place, but out of here, you're like, I'm going to close this, and you close it here. However, when you take a trade in the other case, and let's say you bought, let me clean this up. Say you bought here, for example, and you place your targets to be here, or you place your stop loss to be here. And then when you buy, the market do like this and start coming down. And as the market is approaching your stop loss, you're like, this thing is going to go up, or you remove your stop loss, right? So you cancel your stop loss as it's canceled and maybe push it down. And then the market start coming down to your stop loss again. And then you cancel the stop loss, you push it down. Before you know, you're now only praying, if this thing can just go up and reach my entry price, I'll close it for break-even. And then at some point, you probably find yourself in a very big drawdown. Maybe you blow your account or stuff like that. I'm sure several of us here probably have experienced something like that, where we let our emotion get to us. Now, when it comes to trading, our emotions can be, our emotions is usually a disadvantage. Now, the only way to fix that is to develop trading rules for yourself. Develop set of rules that you want to stick by. Develop set of trades that you want to take. It's criteria that has to be met before you take a trade. And then what you should do once you take a trade. So if you place your criteria, once the criteria is met, you place the trade. Well, you let the trade run, and then you control, you don't try and interfere unnecessarily, unless maybe let's say something negates your outlook. So depending on the reason you entered, if the outlook is negative, then fine. But minus that, you stick to your rules, and even the outlook negation should be included in your trading rules. So you stick to the rules and then follow the rules. Forget about what your heart is saying. Stick to the rules. Win or lose, the only point that should matter is, did I follow my rules? And one of the only ways to do this is to keep a trade journal. So a trade journal will help you document the trades you took, why you entered, where you're exiting, and then you can go back and review the trades you have taken and see, how you can adjust, how you can improve, how you can optimize. If you don't have a trade journal to go back to, then you wouldn't even know if you're making progress. You wouldn't even know, okay, these are the best trades. You might, from your trade journal, you might now notice that, well, it seems Euro USD is the only trade, is usually the trade that gives me the most profit. And then maybe you might even start focusing on trading just that. But by looking at your trade journals, you'll be able to find enough data, to make trading decisions or to optimize your trading efficiency. And then one very key thing, which I definitely have to mention, is risk to reward. Not even risk to reward. I wanted to say lot size. So the proper risk management in terms of lot sizing, right? Now, risk to reward is very key. It depends on how much you're risking to how much you're trying to potentially make. It's very important. But it differs, it varies. There's, so for example, you can be profitable using a system that has a lower risk to reward ratio if it has a higher win percentage. So what I mean is, if your trading strategy has a 90% win percentage, that means you win 90% of the time. If you have a risk to reward ratio of 2:1, so you're risking 2 to make 1, even though it's not the best risk to reward, but because of your 90% win rate, you would be profitable, right? Now, you will not even know your win rates if you don't track your trades. However, you can have a lower win rate, like a 40% win rate, but have a high risk to reward ratio that even if you lose 60% of your trade, you will still come out profitable. So if for every trade you take, for every trade you're taking, you're risking, let's say, $1 to make 3. So you have a risk to reward ratio of 1:3. So that means for every $1 you're risking, you're trying to make 3. Now, if you take 10 trades or 100 trades or 1,000 trades and you win only 40% of your trade, that means you lose 60% of your trade. Now, if you lose 60% of your trade, in this example, we are risking $1 to make 3, we lose $6, right? So we have a loss of $6. However, for that 40% of the trade we win, which is in this case 4 trades, because for every win we make 3 times, we'll be making $12. So even though our win percentage is lower, our risk to reward is much better, and so we can afford to have a lower win percentage. But because of our higher win risk to reward, we come out profitable. Now, lot sizing is the next big, topic to talk about, right? I don't have a slide on that, but you want to use appropriate lot size. You can have the best risk to reward ratio. You can have the best trading rules, the best strategy and define your edge. But if you use an improper lot size, so imagine somebody has $1,000 in the account. Now you're thinking, $1,000, that's big money. Well, it's not. So you have $1,000 in your account and you decide to trade a standard lot. You decide it's a standard lot you want to be trading. There's nothing stopping you from trading a standard lot. Now, if you take a trade and you win and the trade goes on to hit profit for 100 pips, well, you just made $1,000. You doubled your account, right? What if the account, and let's say you're using a risk to reward ratio of 1:2. So, and you take a trade, your profit is 100 pips, your risk is 50 pips. And then the trade goes on to hit your targets for 100 pips. Well, you just made $1,000 and you just doubled your account. Now, what if it goes on to hit your loss, your stop loss? Well, you lose 50 pips. On a standard lot, you just lost $500 and you've just lost 50% of your account size. Now, you know the thing about losing 50% or losing money. If you lose 50% of your account size, you will need to make 100% of your new account size to even break even. That means if your account is $1,000 and you lose 50%, that means you lose $500. In order to go back to your original account starting position, which is $1,000, you will need to now make 100% of your new $500, which is your new balance, to even break even. So the more you draw down in losses, the harder it is for you to ever get back to win. So, and one of the key things that usually goes against traders is where you now have a terrible, you're using an improper lot sizing because you're being greedy and you want to make all the money in one day. If you stick to continuous small increments in your growth, you grow your account and you have $1,000 in your account. This is one of the problems I have with people. So people are like, well, stop being can somebody not get, I want to fund $1,000. That's big money. Okay. Well, can I get a trader that will give me like 30% a month? 30% of $1,000 is $300. So you want to be making 30% in a month. Well, while it's not impossible, I've made 30% plus in a month. I don't try to make 30% in a month. I try to be profitable. Sometimes the market is just so favorable. The setups is moving so nicely. And then I can make 30% or more, 20%, 15%. However, if you try to make big money every month or make big percentage gain every month, you would have to probably risk a good amount of capital, because remember, there's no reward without risk. So you have to risk, and then like in that example we use, you're trying to make 100 pips, but you're risking 50 pips. And if you win, you double your account because you're using the standard lot. However, if you lose, well, you lose half of your account. So if you don't use proper lot sizing in terms of risk management, you're going to blow your account sooner rather than later. However, if you focus on small, consistent increments, you grow your account by 5%, 7%, 6%, 9%. By the end of the year, you might be up 70%, 60%, 100%, 200% actually in your account, because you just focus on small, consistent increments. Okay, we've discussed a lot today. We did not look at the charts. So for some of you who are expecting, show me a new strategy. It's not all about new trading strategy. It's all about, sometimes the one you already know and you already have is really, really good. But you just need to define your edge and trade profitably. Okay, so I'm going to leave you with this final word from John Vici. Limit the size of your position so that fear does not become the prevailing instinct guiding your judgment. So that is all we'll be taking today. I hope you enjoyed the training, even though we did not look at the chart and look for strategies and all of those things. But in my opinion, this is actually as much, if not more important than that. You want to ensure that you manage your risk. You want to ensure that you define your edge. You want to ensure that you know what you're getting into in terms of before you enter a trade, know what you're risking and what you're trying to make. And do not trust your heart. Trust the chart, right? Don't trust your heart. What you want to do is trust the chart. And then surely you can continue to learn from me and from all our mentors. Make sure that you have an account with us, fund your account, as if there's anybody here that has not done so that you can at least continue to take part in my classes. I'm going to make this Wednesday class clients only from, I think, next week. So it's going to be only open to clients who have funded the account. And I'm sure I can even bring more exclusive content to clients. I'm sure I'll still have some Friday class will still be open to everybody. We'll still have classes within the week. But in order to take part of joining my trading rooms, look at trade opportunities in the market together, please make sure that you fund your accounts. if you're fund your accounts, and then that's really, if you, so just participating in my trading room is one thing. If you don't have enough account size, at least I expect everybody to be trading with at least a $500, if possible, or at least a $300 account size, so that you can have enough margin to trade as well. Right? Focus on growth, focus on consistency, and you know, at the end of the day, you would smile. You would smile very broadly if you're able to stick and become the best trader that you are designed to be. Okay, thank you very much once more, guys. I hope you enjoyed the training. I'll see you in the next training. If you have questions, I'll take the next 1 or 2 minutes to try and sort them out. Okay, with the exception of that, that is where I'll be wrapping up for today. Let me know if you enjoyed the class. Let me know if you enjoyed the training for today, and let me know your thoughts. Okay.